No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about, we've been talking about how tax planning changes over the 4 stages of retirement, and we're going to wrap that up today. But in addition to that, I want to talk a little bit about the stock market. This is one of those areas right now. I'm watching the market. It's up 20% now. We're seeing a bit of about a week here of or 7. I think it's going on. It'll be 8 days today if we have a positive day in the market, which it appears on the open that we're going to. So what does that mean? It means we're basically about 0.5% off of all-time highs, which when you think of all the volatility we've seen here in the last couple of months, that's kind of surprising, right? But we're up 20% year to date, to put in perspective. Now, again, remembering the S&P last year, the market lost about 5.5%. Here's what I want to impart upon you that I think is so important to understand with the markets, is not to get complacent. So when we see double-digit returns, as we have for the last 10 years, right? So again, we're up 20% year to date. If we put into context over the last 10 years, this is the longest bull market in history, right? We're up about 13% a year. So this is really good news. We're thinking, wow, this is excellent. However, we can't get complacent. This is one of those areas that you really need to pay attention, because this is a great time again to stress test your portfolio. Have to have an analysis done to see what type of impact the next bear market will have on you. And here's why I want you to understand that, is that if you think in terms of the last 10 years at 13, that's exciting news. However, let's look back. Let's look back over the last 20 years. Okay, because over the last 20 years, the average return's only been about 4.5% a year. So man, it's quite a difference, right? Think of that. That's how bad that first decade was, from 2000 through 2009. So what we want to be thinking now is, of course, forward thinking. What about the next 10 years? What about the next 20 years? When you get into your retirement lifetime, what's that going to look like? And how can you, in fact, do better? And there are ways, by the way. The S&P, as I mentioned, the S&P 500 index, as you know, that's right, that's the 500 largest companies in the United States. It makes up 70% of all the money in the stock market. It outperforms 90% of mutual funds that you might invest in. And of the 10% that outperform the S&P, right, each year, it's not the same ones. In other words, someone just gets lucky. A money manager running that mutual fund just happens to get lucky and beat the S&P. And maybe they get lucky for 3 or 5 or even 10 years. Okay? But when you look at the research, the academic research shows this with many studies on this, that when you look at the top performing mutual funds over a given 5 and 10 year period, those that have outperformed the S&P, when we look at the subsequent period, in other words, we measure for 5 years, and then we look how they do in the next 5, and they underperform the market. Then we look for the top performers that outperform the market for 10 years, and we say, and we pick that period, right? And then we say, how about the next 10 years? How do they do? And they underperform the market. So we know from this that they basically just got lucky and just happen to have the right things at the right time, the right stocks, if you will, or bonds. So what does that tell us then? It also tells us that when it comes to investing in the market, that the S&P 500 index fund, just investing in an S&P 500 index fund, would outperform most any other option that you might choose, but not all. All right? Asset allocation modeling. We're talking now about modern portfolio theory. And this is modern portfolio series now has been established over the last 60 years. We have 60 years of Nobel Prize winning academic research showing us how, in fact, to construct a portfolio, which asset models, which asset classes to put together, and in what manner, all right, what percentages, to get a desired result. And that desired result is to get a market return, but with lower risk, lower volatility. And that is the downside with the S&P, as we've talked about before, right? We know that it's got a high standard deviation, which is a high measure of volatility. Now, going forward, when you're going into retirement, when you're starting to take money out of your retirement accounts, volatility can be a real problem for you, okay? We talked about sequence of returns risk many times, and what that amounts to is when you're taking money out, this can be the difference between potentially running out of money and having plenty of money during retirement is addressing that risk. And we're going to talk a little bit about that today as well in with the tax planning, because it's all, again, not just what you make, right? Because that has to do with taxes. If we make a lot but we end up paying a lot out in taxes, it reduces our net return. If we make a lot in the market but in downturns we give most of it back, right, then that reduces our net overall average returns. So what we want to do is make sure that we keep more of that money through good tax planning strategies, tax efficient investing, tax efficient income strategies, and of course when it comes to investing, it's also about reducing volatility. Reducing that volatility while still getting the desired rate of return is the goal, that market return. So asset allocation, this is a great time again to be looking at your portfolio, and you might be thinking, wow, I'm doing great. Well, I see, new clients are coming in all the time, and I'm seeing when they're coming in, their portfolios, what they're heavily weighted in and what most advisors are pushing are large cap stocks because of the last 10 years and how well they've done. The problem is that's that, live by the sword, die by the sword type of mentality. If you get heavily weighted in that asset category, yes, you may do well in the short term, but when it takes a hit, keep in mind the last two bear markets, we had a drop of 45% and a drop of 55% in those two. Imagine giving back half of that money, right? And you can see how problematic this can be. And imagine losing half of what you have just, as you're leading into retirement or just starting retirement, or even if you're heavily weighted in large caps now and you're well into retirement and taking money out, this could be devastating as far as your retirement plans and your income. So a good way to do, again, is a good thing to do at this point would be an take a look at your asset allocation model. If you're not sure about doing an analysis as far as what to look for, then get with a good advisor. Find yourself an investment advisor that's a fiduciary that can help you do this analysis and stress test your portfolio to see what's in there. And I'm going to share some things with you about that as well, some other things with regard to bonds and how that market is changing and rather rapidly and very disturbingly, and what that could mean as far as your portfolios as well. All right, so if you don't have an advisor, then give my office a call. In fact, you can call 615-376-5325. We'll get it up on the screen for you. There you go. 615-376-5325. If you don't have an advisor, if you need someone to help you with doing an analysis, come in and see me. There's no charge for the offer. What we'll do is we'll do up a comprehensive plan for you. We'll take a look, we'll stress test your portfolio. I'll pull Morningstar reports. I'll show you what's inside the different mutual funds that you have and the potential risks that go with those funds. I'll show you the model portfolios that we use using indexing strategy and how those are put together and how that compares to what you're currently doing. Help you with these asset allocation models to help you protect yourself and make sure, again, that you're going to be able to have financial freedom in retirement. And that's what it's all about. It's about making sure that you're able to attain and maintain your standard living quality of life no matter how long you live, and not have to worry about running out of money. And ways to do that are some of the tax tips we're going to give you today, and of course some of this the investment tips I'm talking about as well. So there it is, 615-376-5325. We'll also answer questions you might have about Social Security, Medicare. Again, it's comprehensive planning. You have to look at the whole picture. There are so many different moving parts when it comes to retirement. It's not just your investments, right? What about income? What are you going to have for income sources? Are they going to be fixed sources? Are you going to have a pension, for instance? Or you will have Social Security? Are you going to have any other income sources like rental properties, or maybe you have an annuity that's going to provide you some income? Whatever it is, we look at all your income sources. We look at your expenses. What are your expenses to maintain your current lifestyle and to be able to do the things you want, add fund money and do the things you want in retirement? And we factor in for inflation. Those expenses are going to go up over time. So you need to factor that in. If you need $60,000 a year to live on right now to maintain your standard of living, then that means you're going to need probably somewhere around $80,000 in 10 years' time to do the same things. If you need $100,000 to maintain your standard of living today, right, then you're talking about probably around $130,000, $135,000 in 10 years' time. If your assets don't grow to keep up with that, if your investments don't grow to keep up with inflation and, of course, to cover taxes as well, and to allow for growth of your income over time, then that puts you at risk to having to reduce your lifestyle later in life. So these are all the factors. Basically, we gather this information, your income, your expenses, your assets, your liability. We factor in rates of return. We're going to help you determine what's the needed rate of return to accomplish your financial goals, to be, again, that lifestyle part. We'll show you basically your financial future based on the things you're doing today. I can show you 10, 15, 20, and more years down the road how much money you will have based on the things you're doing today, and then share strategies with you on how you can improve that picture and minimize risk in the process. So there it is, 615-376-5325. Give a call. Tessa's standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right. When we come back, I want to take a quick break. When we come back, I want to talk a little more about the investment part, and then in the markets and some things you need to be aware of, especially with the bond market. And then we're going to jump back into tax planning changes over the 4 stages of retirement. All right, but first a break. Join us here. We'll be right back on the Retirement Report.